In the half year to 30 November 2025, the Trust net asset value was up 5%, while the share price delivered a total return of 4.5%. This was behind the benchmark, which rose 7.4% over the same period. Despite this, we're pleased to declare an interim dividend of 7.5p. It's been a challenging period. Uncertainty around the government's second budget created volatility and held back overall returns. Our results were behind the benchmark because we did not own some of the top performing companies on our index as they didn't fit our investment style. We focus on growth businesses with high quality fundamentals trading at reasonable valuations and which meet our liquidity requirements. We did have several positive contributors, Balfour Beatty being one of them. This construction and infrastructure company saw its shares rise on strong demand for projects in power generation and defence, and better than expected cash returns. Another winner was Just Group, a specialist in pension risk transfer, which attracted a takeover bid from Brookfield. On the detractors, we didn't own Goodwin, an engineering firm that saw strong upgrades over the period, or SolGold, a gold and copper mining company which benefited from rising commodity prices. Portfolio activity included adding several new companies we believe have strong growth potential, starting with CVS, which is one of the UK and Australia's leading veterinary groups. It was added after the UK's Competition and Markets Authority completed its review of the vet sector, which clarified the outlook for margins. To us, CVS shares look undervalued and attractive for the long-term growth it offers. We also added Mighty, a facilities management company enjoying record demand for its services, and SSP Group, which runs food and drink outlets and travel hubs worldwide, as we expect improving margins and cash flow in Europe. Lastly, we added Tatton Asset Management, which provides investment services to independent financial advisors in the UK. The firm has been benefiting from growing and continued demand. We also took profits in Cohort and Keller and sold our position in Domino's Pizza, where growth prospects were hit by recent tax changes. Interest rates in both the UK and US are coming down, which should help economic growth. This is good news for UK smaller companies, which tend to benefit most when borrowing costs fall. However, inflation remains stubborn, so it's hard to tell how far and how fast rates will drop. Political uncertainty also continues, with the government under pressure after two heavy tax-raising budgets. Despite these challenges, UK shares look cheap compared to global markets. While many headlines focus on US asset bubbles, we see great opportunities in UK smaller companies that offer portfolios both diversification and growth potential. Given how oversold this part of the market is, it may not take much by way of flows to spark a recovery. We remain cautiously optimistic for the year ahead.